Hello, Fiona. Good afternoon. Oh, good
Hi
morning.
there. Yeah, well, it's morning here, but afternoon for you,
Yeah,
isn't it?
yeah, that's true. Yeah, yes. How the technology can connect the afternoons and the mornings now.
That's it, yeah.
Yeah. Okay, we are ready.
Yeah.
I went to your Western Group cash flow statement. So yeah, right up to operating cash level, we did it yesterday, that day. That was all right. That is 124 all right. Now,
Yes, that's what we went through,
yeah,
wasn't it,
that's
together?
right. So
Yeah.
that is under control. Then you have very well done the property, plant and equipment, that part of it. Purchase of property, plant and equipment, 74 figure is right. Right.
Okay.
Acquisition of 40% interest in associate. That's a fantastic work you have done. You have got the 90 figure. That is superb. That was a difficult one. That also you have got it. Dividend receipt from associate companies +4. That is also right. Then we have contingent cash paid 7. That is also right. Sorry. Contingent cash paid 7. That is also right. Purchase of intangible assets 17. That is also right. So there is one big figure missing. One figure is missing. The disposal of the subsidiary, the money we got, and also another one. That was this thing.
I'm sorry, I didn't quite catch that. What was the other one?
What was the other one? Yes.
Sorry, the sound went a bit funny. I didn't catch what you said. What was the second one? So disposal of subsidiary, and there was another one.
Acquisition of subsidiary, the disposal of subsidiaries, sure you did not do it. But what about the note number 6? No, sorry, not number 6. What about the note number 7? The financial asset amortized cost is a 20 million 2-year loan which Western gave to an unconnected company on February 2015. That was, I know that was a very tricky one because we don't see that way. Right? But that was given on the 1st February 2015 on interest. So that is true enough because we were focusing on the impairment and all that, but we did not realize that was money that went out from this cash flow on the 1st of February 2015, isn't it?
Yes.
So that should have come. So one investment activity that is not there is the 20 million. That should have definitely come. So you will have the minus 74 minus 90 plus 4 minus 7 minus 17 and 20 minus. Now let's work out that other one, the big one, 87.4. Now to work out the 87.4, because they have not given us the disposal proceeds, what they have given is they have given us the loss on disposal. They have given all that. So we have to work out the thing. But before working out that thing, we have to do few adjustments on the property, plant and equipment. Now let's look at the figures. Property, plant and equipment. They say it is 80 million at the time when they took over. But they are talking about when did this acquisition took place. The acquisition took place on 31st July 2011. When are they disposing? 31st July 2015, 4 years later. Right? Yeah. There was a fair value uplift of 16 million.
Yeah.
At the 2011. And it had a period of useful life of 8 years. How many years have gone now? 4 years have gone.
Yeah.
So there is still a half of that 16 million, which we have to add it up to our property, plant and equipment. So the property, plant and equipment figure will be not 80, but it will be 88.
88. Yeah. See that. Yeah. See that was worked out for the property, plant and equipment as well. I've got that on my working.
Yes. You did that one. But for the disposal also, you have to bring at the time of disposal, the real figure is 88 in the consolidation.
Yeah.
80 plus the unabsorbed fair value adjustment 8 million, 88.
Yeah.
No problem, it is 38 million. Right? Trade receivables, no problem, 23 million. Trade and other payables, no problem, it is 10 million. Deferred tax, we have to adjust it. You remember on the 6 million, on that fair value adjustment, there was a 25% deferred tax. On the 16 million, 25% is 4 million. Half of that is still there. So there is still a 2 million deferred tax. This we took it when we were doing the operating activity. We took that deferred tax increase liability. So here also, deferred tax figure will be not 6 million, but it will be 8 million.
8, yeah.
Then the bank overdraft 2 million. So that will give us the total tangible assets and liabilities, or total net tangible asset figure we can find out. 88, 38, 23, minus 10, minus 8, minus 2.
Yeah.
How much is that figure? 88, 38, 23, minus 10, minus 8, minus 2.
$145?
No. 88,
no.
38, 126, 149, minus 20. I get 129.
Okay.
88 plus 38 plus 23 minus 10 minus 8 minus 2.
Oh, I think I added the 8 rather than deduct.
Yeah, I think you would have added up something.
Yeah, okay, right, I'll try again. It should be right now, hopefully.
Yeah.
129.
129. What was the goodwill after writing off? They had to write off a big goodwill. What was the goodwill what they had? They had to write off 75% of something, the goodwill, if I remember right.
Yeah.
What
so the balance on the goodwill was 9 million.
9 million. So this is your total assets what you will dispose. But this is your total assets you will dispose. What is the NCI that you will be disposing? NCI at the beginning when we acquired it was 28 million. Right? The examiner said the NCI at the beginning when we acquired it was 28 million.
Yeah.
Right? 28 million. Now what is the post-acquisition profit of NCI? What's the post-acquisition profits of NCI? When they acquired the retained earnings, I think they said some figure. The shares have been on for a consideration of 132 when the fair value of the assets was 124 million. $124 million. That is the fair value of the assets what they acquired. Now what is the fair value of the assets? Now this was the most trickiest part of it. Yes? What is the net value? Yes?
129.
Yeah, excellent. Brilliant. 129. Right?
Yeah.
So the post-acquisition profit is how much? 5 million. 124 to 129.
Yeah.
5 million. So what is the NCI share? 20% of 5 million.
2.5.
No, 20% of 5 million is 1 million, isn't it? 20%.
Oh,
Don't give too much to NCI. You'll be very,
20%.
you'll be a very generous girl.
That's one. Yeah,
That's
one.
That's one. And what about the goodwill? Because they also have a goodwill. The remaining the goodwill impairment was 27 million. Of the 27 million, 20% is their share of the impairment. So 5.4.
Okay.
So your NCI figure at the day of disposal, 28 plus 1 plus minus 5.4.
Yeah.
So that comes to 23.6. Right?
Yeah.
That comes to 23.6. So now we know the value of the NCI what we dispose. So now we can calculate the ultimate figure that what we have, because what we are disposing is the entire goodwill plus the asset, which is worth 138. And for that what we get is the consideration. We do not know that figure. That is what we are trying to calculate. We are disposing the 23.6 NCI, right?
Yeah.
We are disposing the 23.6 NCI, and what else we are disposing? We are disposing for the 128. We are disposing the 23.6 NCI, and we are disposing the consideration we are getting 23.56, and we know on the transaction we have lost how much? We have lost
29.
How much?
29.
29.
Loss on
Disposal is 29. So consideration plus the loss plus the NCI should be equivalent to 138. Consideration plus the loss plus the disposal should be equal to 138. That is the total net assets we dispose. From here we can find out the consideration.
Yeah. It would have been kinder if they'd have just given the consideration, wouldn't it?
Yeah. Normally that's what we get, no? Normally we get the consideration. But here they gave the other way about. They gave the loss for us to calculate the consideration.
Yeah, and that really confused me. Yeah, especially in the time as well.
Yeah,
dealing with all these other areas.
Exactly. Exactly, you're right. So what is the consideration we have got? We have got a consideration of how much? 85.4, was it?
Yeah, 85.4.
85.4. Although we have got a consideration of 85.4, when we go for the cash and cash equivalents, we have to remove the bank overdraft also. We have to remove the bank overdraft also. So because we are removing, we are getting sort of a bank overdraft. So in fact, the net proceeds what we receive is 87.4.
Yeah.
If we had cash, we will deduct it. But here it's overdraft, so we have to add it, and that is 87.4.
And how many marks would that be worth, that calculation?
Pardon?
How many marks would that calculation be worth?
That calculation would have been worth about 4 marks, I would imagine,
Yeah. It's a lot to do for 4 marks, isn't it?
It's a lot to do with that one. Yes. Because this adjustment, it was not that difficult, but to think about it is very difficult. So this is why it's good. Now you know if a question like this comes up, without the consideration, you know exactly what to do.
Yeah.
So now we have got that figure 87.4. So that's the next figure that was missing in your accounts.
Okay.
So now if you put that one, back to this thing, go to the investment activity, minus 74, minus 90, plus 4, plus 7. This is the last one, purchase of intangible assets. You have put it is minus 70, no? This one?
Oh, yeah, I'll put it as plus, haven't I?
Yeah, it should be minus 17.
Yeah.
Right? It should be minus 17. So now we added two more figures to that one. What are the two figures we added? The minus 87.4 and also no, sorry, not a minus 87.4, plus 87.4 minus 20.
20, yeah.
Can you see what that figure will be now? Minus 74, minus 17, plus 4, minus 7, minus 17, minus 90, yeah. Plus 87. Yeah.
116.6.
116.6. So that is your second, second compartment, 116.6 minus. First compartment, 124 plus, 116.6 minus. Now we come to the financing activities. Financing activity, where did you go on? We had the 22, that is perfect, all right? Right? Only thing what you missed was, what about the dividend that was paid to the NCI? Parent company did not pay a dividend. True. But what about the NCI dividend? So we have to do a little working again.
Okay. Oh, see, I read that and that's it. I thought, right, I don't need to do anything with that.
Because true enough, the parent company did not. That was confusing because the examiner says the parent company did not pay a dividend. Just because the parent company did not pay a dividend, it does not mean the subsidiary has not paid a dividend.
Yes, and they did, didn't they? Because we've got a figure in dividends received.
Yeah. So the subsidiary paid a dividend. But Western did not pay a dividend to its shareholders. So we have to calculate that dividend first of all now. So we know the opening balance on the day that when we took the NCI, opening NCI figure. On 31st July, we can look at on the balance sheet. Balance sheet NCI figure is 85 at the beginning, isn't it?
85, yeah.
85. Then from your P&L, so that was 85. Then from P&L, there was a total comprehensive income. $11 to the non-controlling interest.
Yeah.
So 85 will go up by 11, 96. Right? When we dispose the subsidiary, we just worked out that figure. When we dispose the subsidiary, we dispose the NCI figure of 23.6.
Yeah.
That is the figure that we just worked it out. So now we can see 85 plus 11 minus 23.6. What should be the figure? 85 plus 11 minus 23.6 should give us our NCI figure. NCI figure should be 72.4.
Yeah.
What is our closing NCI figure? Closing NCI figure is 64. In the balance sheet.
Yeah, I'm just looking for it. Where is it?
Yeah.
Oh, yes, yeah.
64.
64.
So from 72.4 to 64, the drop is because they have paid a dividend.
Okay.
So that should be normally treated under financing activity. So your financing activity will have two figures, what you had and the 8.4.
Yeah.
So your financing activity should be having 30.4. So your three compartments will be operating activity 124 plus, invest in minus 116.6 plus the minus financing activity 30.4 should give you the cash flow, the net increase or decrease in cash and cash equivalents. 124 minus 116.6 minus 30.4.
Yeah. And what does that come out to? 124. 2307.
Yeah, 23.7. Yeah, 160. No, 23. No, 124 minus 116.6 minus 30.4.
Yeah.
23 minus 23, correct? 124 minus 116.6 minus 30.4.
Yeah.
Minus 23. Minus 23. What was the beginning cash balance? What are the opening cash and cash equivalents?
Oh, that was 43.
43. So minus 23 plus 43 should give you, hopefully, the closing cash balance should be 20.
Balanced.
It's all right.
Yeah.
20. Yes, right. So that should be the way to do it. So you did. You did great. Right? Came up to a certain particular point. Disposal of subsidiary, you had an issue there. That is a big calculation that you must learn again to redo that part of it. You have to restate the assets to the fair value and then look at the consideration. In this case, the consideration are not given. So we have to work backwards and get the consideration. Those were the few things what we have to look it up. Then the other one, of course, most obviously you missed one, that 20 million, because that was not very not very clear, not that very clear, not very visible, that one, because it was in that 20 million we were working on the impairment, but we forgot that the company has invested 20 million. So if I was doing this question, what I'll do is, in each of these things, I will go and try to write whether it should fall into the investing activity, finance activity, etc. And I will try to write it in the notes here. Under each of these things, I will see. Now, when you dispose the entire equity holding, we know it's about investing activity, right? So we know that it has to be something to do with the investing activity. We will probably have a gain or a loss, that 18 million or something, that we know it has to be under operating activity. So I will just put a side note here, investing activity and operating activity.
Yeah.
Something like that, so that I won't miss. And if we had done that one, I would have seen when I came for the note number 7, in a cash flow, always you must know where this information should finally go. When I came to the note number 7, I know there is an operating part of a 20 million, the impairment, but also I will realize there is investment of 20 million, and that I will say investment activity. So that way, if you write it, you probably will not miss it.
Yeah. I think you kind of run out of steam, don't you? You start off really well, and then because there's so much to do in their time,
I know.
You lose your flow, don't you?
Exactly. So the idea is not to get panic. Idea is rightfully or wrongfully not to get the full marks, or I would say practically, right? You must not panic because you can't do anything, because you have to remember you need only 50% of the marks to get through the exam, which you would have got it the way that you did. So just don't panic. Try to do as much as possible. But on the 50th minute, I will say 55 minutes, I will stop the answer here, go to the next part.
Yeah. And I guess that's, that would have been where I would have stopped, because I thought,
Yeah. And then, okay, if I have time, I'll come back. Otherwise, I'll forget about it. Now, before I move into the other question what you did, what about the second part of it? Because this is only 35 marks, not enough. I need a little bit more marks. What about this one? Because there now, What I'm trying to say is, in that 35 marks question, in the first 50 minutes, you would have done your best. After that, even if you spend the balance 15 minutes on that question, you will not be doing too much because your brain is tired, things are not coming, everything is mess, wired, cross connections, everything. Right? It is better to use that 15 marks to do this part of the question, because by doing this thing, you might get another 3-4 marks, which you may not get it even if you wait for another 1 hour in that question.
Yeah, exactly. Yeah.
Right? But if you keep on doing on the first question, you might lose at least a couple of marks, but you can get on this second part of it. So this is why I always tell all my students, never drop a question. Never drop even a part of a question. Write something.
Yeah.
So now I will come to this one. What do you think of here?
Yeah, that's yeah. I didn't like that question.
Yeah, I know. No, many don't like this question, but always you will see, CMARC, ACCF's first question. Second part is all about IFRSs and something. You remember last time we discussed something about IFRSs, and there was a question about IFRSs. Here also again IFRS question.
Yes.
CMA examiner never gives this kind of problems for us, but ACC examiner gives this kind of problem.
And it's very specific to certain areas, isn't it? And you think actually it's such a small section of the syllabus that they're actually examining. Because
exactly. You're right. Yeah. Now let's look at what are they talking about here. The directors have been reviewing the IFR, International Integrated Reporting Council's framework for integrated reporting. So integrated reporting is going beyond your financial statement. It's all about, not talking about the socio-economic factors of your company. Right?
Yeah.
So it talks about in different areas, the economic side of it, the environment side of it, and the social side of your company. So directors basically believe IFRSs are already very extensive, no doubt about it, and provide stakeholders with a very comprehensive understanding of financial position and performance for the year. In particular, the cash flow enables stakeholders to assess liquidity, solvency, and financial adaptability. And therefore, why additional disclosures? And they believe by giving additional disclosures, it is too excessive and it will obscure the most useful information set within the financial statement. And therefore, they are not very sure whether we should implement these things separately or combined or as an integrated report. Discuss the extent to which statement of cash flow provides stakeholders with useful information about an entity, whether this information would be improved by entity. Now, after talking so much in the so many lines about IFRSs and financial position, all that, what are they talking in the last 3 lines? They are only talking about the cash flow.
Yeah.
Asking us to discuss the extent of the cash flow statement in providing useful information and whether this will get improved by entity introducing an integrated report. So we have...
So when I read that question, firstly I'm thinking I'm not really sure what they want from that answer, but it's whether you discuss the purpose of the cash flow and what that's going to highlight to the stakeholders, or they're talking about the integrated reporting, which is from the cash flow. The cash flow would highlight cash movement, which may be connected to social or environmental costs that have been spent. But it's just understanding what's expected in that answer.
Basically we have to talk about the extent to which cash flow provides stakeholders with useful information. That's the first part of it. How much useful information the cash flow is providing. One thing what we know, if you compare the financial statement, cash flow is a very factual statement. Because because the P&L and the statement of financial position can be somewhat manipulated through creative accounting, through your accounting policies and all sorts of things. But cash flow is the only factual statement because it starts from your opening cash balance to the closing cash balance.
Yeah, and that's obviously the survival of the business.
Exactly, and that basically will tell us about the company's liquidity, right?
Yeah.
Will give us a lot of indication of the company's liquidity, etc. And also looking at the financial statements, the cash generated from operations is basically an indication of the quality of profit generated. Because it is the profit that is after setting off all the financials, working capital, everything, book entries, etc. So that will give a very good quality information about the profit that had been generated in terms of cash flow.
Yeah, and that can be misinterpreted by stakeholders.
Yeah, that can be in a way that can get misinterpreted because sometimes you might have a big profit, but when you look at the cash flow from operations, I'm not talking about the entire cash flow, I'm talking about the operation. If it's a negative figure, the people who are sensible will get alarmed. Actually, it's not I don't say it's a kind of a misinterpretation. It can get, you should get alarmed. You have a bigger profit, but your operations, the generated cash flow, because the reason is either you have excessive stock or either you are selling on excessive credit. Although there's profit in the books, there is no money in the bank.
Yeah, and if there's no money in the bank, yeah,
money in the bank, which is if it is going to continuously happen, surely it's not a good business. I remember I was doing a little bit of analysis of a particular company. I realized they were making huge profits and they were making headlines saying, so we have made huge profits, but I realized that they were in for a big crisis. They were showing big profits, but no money at all. Cash from operating activities continuously going minus. 1 year I could imagine. 2 years I could imagine. Third, fourth year I realized they were having, because what they were doing is they were just building up stocks, nothing being disposed, but they were showing profits, right? And they were really creating, manipulating, all that kind of a thing. So that kind of a thing will get reflected in the cash flow straight away. And also, investing activity ideally in a company should end up with a minus cash flow. That is you are investing in the business.
Yeah.
Invest in the business. If you are not, if it is a positive cash, you can have a positive cash flow, huge money in the bank account by selling all your assets.
Yeah.
Next year you'll be all right. Next year you'll be all right. In 3 years' time, you are dead and gone because you have sold all your assets, right? So now here also we can see they got 87 some million by selling the assets. Selling, so they can go on doing that much. How long they can go on doing it, right? So that was an indication of the company's financial health or the growth of the company, right? So true, the financial statements provide, the true IFRSs provide a very extensive and required disclosures, very comprehensive, and it has led to some kind of criticism whether we should give any more information, because it can be what we mean information overloading. Overloading. But what is the purpose of this integrated report? Integrated report is basically the financial statements. The cash flow cannot be read isolated, but cash flow should be read in conjunction with your profit or loss and statement of financial position and notes to the accounts. All must be read together. Cash flow, can they manipulate the cash flow statement, Fiona?
I think the cash flow can be more misinterpreted by people who are non-financial rather than it can't be manipulated, because you're balancing back to you're starting with an actual cash figure. Well, you're balancing back to the actual cash in the business.
Yeah. Yeah.
So
yeah, not that it cannot be manipulated. It can be manipulated. You can balance it from opening to the closing, but your compartments can be manipulated.
in terms of
Without putting it on operating activities, you put it on investing activity.
yeah.
So you can
But not
show
if you're following
you
standard.
can show a big operating activity surplus and show a good minus activity in the investing, which the people might think, oh, they are fantastic. Because I said
Yeah.
operating should be plus, investing should be minus. You can show that, but not put in the right things, right components. So it can be manipulated. It can be manipulated in a way. If it is so, it is a very deliberate kind of a scenario, which is unethical, unprofessional, all that kind of a thing. What does all these statements provide? It all together, IFRSs, all those statements, this is coming under IS 7, all these together provides lot about the historical information about the company. It does not provide any predictions about the future of the company. Right?
No.
This is where the integrated reporting has come to stay. It all talks about the history, what happened, how much did you spend on investing activity, what happened, this, that, and the other. The primary purpose, I can note down, the primary purpose of integrated report is to explain to the providers of capital how the organization generates value over time and what it predicts to do in the future. So they will do a thorough examination of the key activities and outputs, specifically referring to financial, intellectual, human, social, and environmental. Now this is where integrated reporting can be very, very useful to the reader, which is not provided in the financial, however, with all the IFRSs.
Yeah.
So integrated report seeks to examine the external environment which the entity operates and to provide an insight into the entity resources and relationship to values that it generates. Totally, it is agreed that excessive information can become obscure and therefore information of material nature should be provided to satisfy the needs of the stakeholders. So this is what is lacking in the financial statements, traditional financial statements, and therefore integrated reporting will be, or rather is, an invaluable resource to the stakeholders for them to make more informed assessment of the organization and its prospects. So in a nutshell, you can see, true enough, IFRSs, all that is very good, but still it is history, still it is past. It is the integrated reporting that will tell us about the company's socio-economic, environmental aspect, and also about the company's future and predictability. True enough, it can become too much overloaded, and therefore that is why integrated reporting says only material information, it should be driven by materiality. So not that every little thing you are going to put and overcrowd the report. You must look at the materiality.
Yeah.
That's basically what you should be looking to answer that question.
Okay.
What about the third part of it? So our financial year was 31st January. Shortly before 31st January 16, Western, the parent company, gave 5 million zero interest short-term loan to its subsidiary, Eastern. Eastern repaid the loan in full during February 2016. So January, just before the end of the financial year, they had given a loan and it was just paid after the balance sheet date. So this is something what we call something in our traditional, we call it window dressing. Just
I was just about to say that.
Yeah, just to dress up the balance sheet, to put a little bit of makeup on the balance sheet. Since the loan was repaid within Western's usual credit term of 30 days, it was classified as a trade-in item at 31st January 16. So it was shown on the trade and other receivable. Consequently, Western included the balance sheet with trade and other receivables, and Eastern included with trade and other payable. Eastern has several bank loans with substantial debt covenants linked to both interest cover and its gearing ratio. The bank loan would have become immediately repayable should Eastern breach any of the terms of the covenant. Right? So they had a bank loan, and if they has breached any of the covenants, they would have had to repay the loan. So some of the covenants are, it's linked to interest cover and the gearing ratio. Before receiving the loan, Eastern had a bank overdraft of 4.5 million. So discuss the impact
so the money
of the loan would have had on the debt covenant.
Yes, the loan would have offset the bank overdraft.
Yeah, surely that is what they did. Because you can see that from the timing, you can see what they did was they took a loan. They got a loan from the parent company, liquidated the bank overdraft, and that's what they did. They liquidated the bank overdraft. So there was no bank overdraft at the end of the period. So there was another bank loan, but they had several bank loans. They had taken several other bank loans. The bank loan said there were certain covenants to make with interest cover and the gearing ratio. Now the first question, there are two parts to this question. First of all, whether the impact of would have on the debt covenants. So what are the debt covenants? One is the interest cover, the other one is the gearing ratio. Now what is interest cover? Interest cover is profit before interest divided by interest paid or interest charge.
Yeah.
Now will that covenant get impacted by this transaction? Will that covenant get impacted by this transaction? Yes?
No.
No. Why? Yes. Good. Why?
Yeah, no. The answer is no. Well, they've incorrectly shown it as they haven't shown it as a loan anyway. They've shown it as the interest itself isn't affected because that hasn't been adjusted by this cash payment.
Yeah, because why interest is not affected? Because it's a zero interest loan.
Yeah, it's interest free.
Interest free. So because of that, there is no additional interest coming up, and therefore the covenant in respect of interest is not breached by this transaction.
Yeah. No.
Correct. So that's the first part of it. What you would probably want to say, the covenant in respect, since the loan is interest free, the loan will have no impact on interest cover of Eastern. Because the subsidiary will not pay any interest.
No.
So the profit will not be affected, finance charges will not be affected, and therefore there is no impact on the covenant as far as the interest cover is concerned. What about the gearing?
The gearing would be affected. Well, they put, if they show it correctly where it should go as a loan, it would affect the gearing.
Because it is debt divided by debt plus equity, isn't it? That is what the gearing is. right? Now they showed this as a
receivable.
as a payable. There's a subsidiary, right? Because we have to look at from the subsidiary's point of view, no?
Yeah.
It is a subsidiary Eastern we have to look at. So Eastern showed it as a payable. So because it is under payable, it will not be reflected under debt. So therefore, the gearing can get affected. If they have properly shown it, it should have been a loan and gearing could have got affected.
Yeah, it would have been if they'd have correctly shown it as a loan.
And if not so, if the overdraft was there, if the overdraft was also considered as part of the loans, because they were paying interest, overdraft was considered as part of the loan, still the gearing would have been affected. But now the overdraft is settled.
Yeah.
So to that extent, there is a good possibility that they have breached the covenant in respect of the gearing. Right? In respect of the covenant. So if the overdraft was included with debt, it would have improved it would have had an impact on the gearing. And if this loan was properly shown as a loan, it would have still have an impact on the gearing.
Yes, yeah. And obviously it's...
Yeah, accountants have a responsibility to issue financial statements which do not mislead the stakeholders of the business.
Yeah, and it's misrepresented as a payable rather than a loan.
Exactly. So here you can see that there is an ethical aspect, because if you remember ACCA Code of Ethics, it's a kind of the principle of integrity is somewhat breached. Yeah. The principle of objectivity is somewhat breached, and principle of professional behavior breached.
Yes.
Because the timing and the nature of the loan will provide that the idea of the loan was to breach the covenant. It was given just before the end of the month and settled just after the end of the month. So it is something to do with the old, what we call window dressing.
Yes.
Right? The loan is given for an unusually short period and it was repaid within 30 days, and therefore there's some kind of a suspicion that was just issued prior to 31st just to dress up the balance sheet of Eastern.
Yes.
And the classification of loan as trade and receivables on one side in the parent and on the other side in the subsidiary as trade and other payers will be misleading. Loan is not for trading purposes. Loan is a loan, right? What can be shown in the trade and other payables is all what we have to pay to the supplier. So loan is not a payment to the supplier. So therefore, it is a misrepresentation or not a fair representation to include the loan within the current assets and as a short-term loan within the current liabilities and under trade payables. So therefore, this loan should have been treated as a debt, with gearing calculated properly, taking that as a debt, and therefore it is misleading and unethical. So surely the breach of the covenant has taken place. Surely unethical act has been done by the people who have prepared the financial statement.
Yes.
So that's what we should be discussing in a question like that. It's a good question. It covered a lot of areas. So what I would like is for you to look at carefully and think about, particularly the IFRS, your favorite, and also the other part of it, about this part of the thing.
Yeah.
Because the big question only carries 35 marks. Still there is 15 marks, which we need to collect fair amount from that one for us to get to the exam.
Yeah, and I think some of these questions where they're looking more for, you don't feel like you've given any thinking substance in the answer.
Yeah.
Although, because you're not really sure what they're looking for, but I guess this one's probably a bit clearer with what needs to be discussed.
Exactly.
But yeah,
sure. Yeah, because I think it's, I have seen in ACCA, a lot of students, what they do is they overspend time on the 35 marks and they don't attempt, or they just try to write some brushing answers on the last two
Yeah.
parts. That is not
Yeah.
helpful at all. That's why I always say stop the 35-minute question in the 55th minute. However much you have written, go and do something on those two also. Because at least you can write something. You may not be 100% correct. You can write something.
And in fact, in one of the exams that I took for P2, I actually did one of the other questions first. I did the part, because I looked at the other questions and I thought I really knew a lot of knowledge about one of them. So I thought, actually, I'm going to do that one first and then go to the main question afterwards. But again, I didn't quite pass, but it was close.
I just have taken that approach. Most of the time I've taken one of the smaller questions where if I feel I can do better, that will give me some kind of a moral, the confidence also. So I have been doing that way because sometimes when you do these 50-mark questions, you are really dead tired. You don't have anything left over in the brain even to do a easy question. Good to do one of those 25-mark questions, an easy question for about first 40 minutes. Try to build up some marks. If I know it is something about IAS 19 or something like whatever area that I have a fairly a good grip, do that one and then go to the big question.
Yeah, it just depends, doesn't it? It's hard to call. I've tried it all different ways and I still haven't passed yet, so I'm hoping this time I'm going to. But
I know. Yeah, no. These papers are very difficult. These papers are very difficult. It's not easy to do this kind of a thing at a time like this. So we have to do something about this one. These questions in a way. To get the maximum out of it. The argument is accumulate marks. Accumulate marks. Collect something from here, collect something from there. Don't get dragged into a big question and stay there for long. Collect little marks all over.
Yeah, and it's hard to, you have to really work out which ones are worth spending the time on and which ones aren't.
And one of the other mistakes that a lot of students do is this, where you have this optional question. Out of the three, you have to select two. You decide one question and you start doing halfway through. Oh, then you think, oh no, this is too tough. And then you think of the other one. That can be a total suicide. You don't have time to play with it.
Yeah, and I find that there's always one question I can discount straight away and think I don't know enough about that, I'm not going to answer it.
Exactly, that is a good thing because you can't select a question, go to halfway, and then think of divorcing that person. That's not the right. That's not the right approach. Right?
There's not enough time anyway.
Whether good or bad, once you select, stay with that man or that woman continuously. Don't try to change the halfway to this. These are some of the blunders we do in the question because there's no provision, no time given for us to do a question halfway through and decide, oh, this is tough, let me look at the question number 3.
Yeah.
You have to, as rightly said, you have to first decide out of the 3 husbands given, this husband I'm going to discard straight away. I'm not going to touch it. And, and once you decide that one, don't ever look at him after that.
Yeah, no. And that's because the questions are quite specific, aren't they? It's it's I found every time I can totally discount one of them completely.
Yeah. So you have to be continuously looking for that one. I want to look at that CP group question. There were a lot of things on that one which I want to discuss with you. We will start off a little bit of that one today.
Okay.
Yeah, the CP question. one. I just went through your question and answer. I want to look at that one with you.
Yeah, the bit I definitely got stuck on the benefits scheme on this one. Again, I think because some of the information they give you and some of it they don't, and it just confused me because...
Yeah, as far as the benefit was concerned, I did not see too much of a problem. Let me see the question. ZP question. Yeah.
But again, I think it's you run out of steam. You start these questions. There's so much in them, and you just get to the point where it's you end up.
Now the benefit question. This is always there in our the question number 1, benefit. Now here we can see our financial year is 30th of June 2016. The net pension deficit at 30th June 2015. What do you mean by that one? Your liabilities are more than the assets. Right?
Yes.
This is one set of assets and liabilities that is permitted by IFRS to set off. Pension assets, pension liabilities. So when we say net asset, that means assets are more than the liabilities. When we say net deficit, liabilities are more than the assets by 14 million. So straight away, what we know is on the 14 million, we must provide interest. We provide interest on the opening balance, and we must take the opening discounting rate or opening interest rate 10%. So first item what I will go and do is on the 14 million, 10%, 1.4 million, my finance cost should go up by that amount. My finance cost should go up by 14 million, 10% of 14 million, 1.4. That goes straight to the finance cost. Right? That is number 1. Contribution into the scheme, the service cost will go to the P&L, 10 million. So no entries have been made. So because of that, our administration expenses will have to go up by 10 million. That is because the service cost is always an item that will go to the admin expenses.
Yes. Yeah.
So that's the next one. 10 million will go there. Right. Then the other one is contribution into scheme will not come into the P&L. It will come into the cash flow if at all. But here nothing. Remeasurement gains will go to the other comprehensive income.
Yeah. Yeah.
Those are the only 3 entries you have to do from this one. 1.4 will get added to the finance charges. Service cost will get added to the admin cost. And the remeasurement gain will go to the other comprehensive income. Those are the only things that what we need to do.
Okay.
Right, of that one. Some of the answer. The revenue figure is all right. So you remember in this case, I think it was a 9 months consolidation. No?
Yes.
So you took the figures 120, 132, and I think the 9 months of that one, you took that one. That was a version of yours. Yeah, 120, 190, and was it 9 months or?
I've got it as 9 months. Yeah.
Yeah. 420, 130, 420. The 132, the Genie was a 9 months consolidation. So you took 99. So that was all right. Cost of sales, your figure 304, 57. .4, 57, 72 is all right, but you missed one point there. You remember there was excess depreciation arising.
Oh, yes.
That I think you missed it. Yeah. Depreciation, there was excess depreciation happening. CP was usual goodwill method. Goodwill had been reviewed. CP disposed 20% consideration. The remaining something. They say CP acquired. So due to tight reporting date, the fair value of net assets had not been finalized by that time.
Oh, yeah.
Yeah, goodwill was calculated using the carrying value of the assets. The fair value of identified net assets finalized on 31st December at 2014.
Yeah.
That was the excess value. So we had to work out that excess value before we could do anything. Before we could do anything, because there was in the BOO, right? In BOO, what happened was goodwill was initially calculated at 28 million, right? So
Yeah.
So the carrying so that means the carrying value of the net assets at acquisition, we could have easily got it. Total value of consideration was 60 million. Value of NCI was 60 million.
12.
Value of N 12 million. 60 plus 12, 72.
Yeah.
And carrying value of the 72. Goodwill was 28 million. Right? So the carrying value of net assets at that time, 60 plus 12 minus 28 would have been 44.
And that was correct.
That was correct at that time, but that was not the correct. Because later on they say fair value of the asset was finalized on 31st December 2014 as 54 million.
Yeah. See, I didn't understand that because there's a sentence which I thought that didn't make sense.
Yeah, because what happened was they when did they acquire? They acquired the company on 30th June 2014. Right?
Yeah.
When they acquire the company, what they say is due to the tight reporting deadline, the fair value of that the acquisition had not been finalized by the time the financial statements for the year ended 30th of June were published. The financial statements as of 30th of June 2014, when it was published, they did not have the proper fair value of the assets. So they went by the book values, and on the basis of the book values, they said the goodwill is 28 million.
Yeah.
Then later
So
on,
when they were finalised on the 31st of December.
Not that you finalized 31st December. After everything was done, they by 31st December, 6 months later, they found the identified net assets of BOO, which was acquired on that day, that is 30th of June, is 54 million.
Yeah. And that did mean the 30th of June, not the 31st of December. So they were finalised the 30th of December, but as at the 30th of June.
Yeah, because it is the fair value of the identified net assets. Identifiable net assets of the BOO is on 30th June 2014.
Yeah. So, that's fine. I did read it that way, but
that's correct.
I just wanted to check because I thought,
because
once they start.
Exactly. Yeah, right. Yeah, because it was tricky. It was tricky because, when you say 31st December 2014, you are thinking of another date altogether.
Yes, and they do confuse things when they start adding different dates into like.
This is the key one.
Yeah.
It was the fair value of identifiable net assets is not on 31st December 2014. Our financials were closing on 30th June 2014, but they did not have time to do it. But now they have found it to be 54 million as at that date, not December.
Yeah. No, that's fine. Yeah.
So now because of that, what happens is your goodwill will come down from 28 to 18.
Yeah.
Right? When you take the new net assets figure, which is the right net assets figure to do the calculations, the goodwill will come down from 28 to 18.
Yeah.
And the impairment should be on 10% of 18, which is 1.8 billion.
Yeah. Oh, yeah. So I did calculate that section.
Yeah. So the
Yeah,
goodwill should have come down to 1.8. And also, because of that, the identifiable asset, the excess of asset was 10 million. It had a remaining life period of 5 years. So, excess depreciation for this year will be 10 divided by 5, 2 million. Excess depreciation arising because we have now got the value of assets at not at 54 million. That 10 million is because of my asset, which is a depreciable asset. And on that 10 million, 5 years, this year my P&L should get added up with another 2 million.
Yeah.
So my cost of sales should go up by another 2 million. So 304 plus 57 plus 72 plus 2 million will be my cost of sales.
Okay, so I just missed that section out on that.
Yeah.
Okay.
I have a few more things on that one because I did a calculation. I'll say, but I want to send you this. Actually, I took a printout of your one, corrected everything. But before I send it, I want to discuss with you. So Monday, we will look at this question clearly.
Okay, yeah, that's fine.
Monday we will look at anything else that on Monday you want to look at, Fiona.
Yeah, okay, yeah. And sorry, were you asking me what I wanted to look at next?
Yeah. Any particular area, or you want to look at anything?
Maybe I'll have another look at the pension because maybe it wasn't so much of an issue as I thought it was. But whatever we look at is helping.
Sure. Yeah, definitely. No question about it. Yeah, so I will look at something tomorrow and we'll try to send you something. But we are going to look at this CP question very well tomorrow on Monday.
Yeah. So I guess maybe we can just look at some more questions.
Sure, definitely. We'll do that.
If you get a chance to send me another question, I can probably
I will do that one tomorrow. Maybe when I have free time, I'll try to look at a question and send it to you. Yes, sure.
Then I can have a look at that tomorrow. Because
then we can Monday, look at that also. Yes, sure.
Yeah, Monday I need to work after our session, so I probably won't get a chance to do Monday, but I can probably have a look tomorrow. And then and then maybe just keep looking at more questions.
Exactly, and that's what you should be doing. Yes, look at the questions what we have done already. Try to look at those questions and see what it is. I think you might get a good idea.
Yeah. Okay. All right then. Thank you.
Thanks, Fiona. Take care.
All right.
Take care.
Thank you. Bye.